Thank you very much, Jim and Avner. It's a pleasure to be here. And doing market microstructure, how old school. The nice thing about market microstructure is it sort of dies, and then, oh, I don't know, you get May 2010, and everyone looks at the flash crash and thinks market microstructure can say something about it. And then Michael Lewis, bless his heart, publishes Flash Boys, and so we start having market microstructure models on that. It's wonderful. I recognize I'm stretching the bounds of the dress code by wearing a sport coat. I have been teaching for 35 years. This is my armor. Thank you. Look, I've been a fan of this paper since July of 2013. If you're expecting me to rip it apart, it's not going to happen. So what I want to talk about is sort of my take on some of the issues, and maybe some of the issues that have to be considered in order to get this to really happen. And I think it would be wonderful if it really happened. So the first observation is, I wasn't that surprised by the correlation result. I mean, I was sort of thinking about these kind of models for a long time, and at short time intervals, there is just plain market microstructure noise, and that's going to drive away some otherwise strong relationships. However, I did not expect the extent of the arbitrages that Eric and Peter found. That was pretty impressive, and it was a pretty impressive data analysis, I gotta say. This is a really neat model, and I just want to point out some order of magnitude things here. Eric pointed out that it would be quite likely for the liquidity provider to be sniped with probability n-1 over n. What is n? I would say we don't actually know, but a guess is that it might be around 20. It turns out there are a whole lot of other high-frequency traders out there, and a whole lot of them in futures markets, not so much in equity markets, which I find interesting. And so, as Eric said, the spread has to reflect this adverse selection. And so the way I think about it is, while the liquidity supplier has information, in fact, the market structure itself makes him functionally uninformed. And so it's the same kind of adverse selection that I talked about with Paul Milgram. And then the auction moves most of that cost, so that's great. Now, it seems to me that in selling this, we got to think about, well, how big are these spread effects? How important are the investment in speed? And so I just did some sort of back of the envelope calculations. They have an average arbitrage profit of $300,000 per day. And I said, well, let's assume half is earned on the spider. Average daily volume is actually a little bit larger than 125 million, but this makes my calculations easy. And so the half spread effect is about 12 mils, 12 cents per 100 shares. And, I don't know, is that big? That's certainly less than a penny. On the other hand, it is on the same order of magnitude as the liquidity rebates, and people have been talking about liquidity rebates for a lot, so maybe it's relevant. Look, this is for the spider. I mean, it's for a diversified portfolio. The volatility is not going to be that great. And it's clear that the arbitrage opportunities are going to be much greater, the greater the volatility. And so imagine the sort of doubles pairs that Eric talks about. There might be larger opportunities, and there might be greater gains in economic efficiency here. Is the arms race still heating up? Well, if you follow Mr. Narang, founder and CEO of TradeWorks is notable for being the data provider to the SEC of the full depth of book information. And he says that there's diminishing marginal returns to speed, and you can imagine that would be the case. In fact, an additional microsecond isn't going to benefit that much. But he also noticed something very interesting, that the speed advantages are much more random. I found that interesting, and I actually discovered something sometime in the last couple of months, and I don't have all the details. But it turns out that you can see a very clear source of where this randomness might come in, and that's that members of exchanges, these high-frequency traders, are allocated to pipes. And we know from Mao's work that the pipes are allocated to particular groups of stocks, but the members themselves first come in a pipe. And what the exchange does is it processes a message in pipe 1, and then in pipe 2, and then in pipe 3, and I don't know how many pipes there are. But what this means is suppose a message arrives at pipe 1, but the exchange has just finished processing a message at pipe 1 and has moved on to pipe 2, then it could be that a later message arriving at pipe 3 in fact gets transacted before the original message at type 1, and this is plumbing that you didn't think you were going to have to listen to, right? But this is, you know, it's these kinds of things that matter when we're talking about these kinds of time scales. And so I think that my conclusion from this is that, yeah, there is still a lot of randomness. Incidentally, what's this structure for? Well, think about how hard it's going to be to quote stuff. If you're a high-frequency trader who are alleged to quote stuff, you're trying to quote stuff, all you do is stuff yourself and everyone else on that pipe. You don't stuff the other people on the pipe. So I think that's one of the reasons for this architecture. All right. Okay, so the question that Eric asked at the end, if this is so great, why haven't we seen it? Well, we have, but not to such great effect, actually. There was the Wunsch auction, which failed, which started in 87, 88, something like that, failed in 2001. They just had no volume. I think what we conclude from that is that 3 auctions a day are not enough, that people want something more like a continuous auction, continuous market, but that doesn't mean that 100 milliseconds isn't close enough to be continuous. And in fact, single price auction, or SPA works by Steve Wunsch, is in negotiations to have an exchange in Arizona, or an alternative trading facility in Arizona. Now, I had thought that EBS, which is a part of ICAP, had a batch auction very frequent on a 3 millisecond basis. It turns out it's not true. Actually, it just is a limit order book. It's just that they process the orders in a different way. It isn't the same. And then something completely different that we have seen is that infrequent auctions have been used in frequently traded stocks, illiquid stocks, but that's not really relevant. So yeah, I think so far we really haven't seen the kind of thing that Eric and Peter are talking about. Does that make it a bad thing? No. Do we have any regulatory issues to worry about? Perhaps not. Certainly it could be an alternative trading system and it can do whatever it wants with its quotes. If it's an exchange shall at all times, such exchange is open for trading, shall display quotes. They will not be displaying quotes in the 100 milliseconds leading up to the cross. That probably can be taken care of is, you know, up with the 99 milliseconds up to the cross, they actually are not open for trading, and so probably not a problem. It seems the bigger issue, and again, this is something that Eric mentions in the paper and mentions as an issue in real life, is the models here compared consolidated limit order book, or CLOB, with their trading solution, and looked at them in isolation. And the bigger question is how will the exchanges interact? You know, the 1974 Act, Congress was very clear. There shall be competition among exchanges and alternative trading venues, and that's such a long-standing law. That's not going to happen. So we're going to continue to have competition among multiple trading venues. I remember even talking to Andreessen, who started. Yeah, maybe that, but actually he was involved with what was the interdealer trading? He was Island. He was Island. Yeah, and we were talking about what the equilibrium would look like in this kind of space, and he said, guaranteed, the buy side will always ensure that there are at least 2 exchanges or 2 viable trading venues because they don't want to be in a monopoly situation. And so, in any event, coming up with this auction design is going to have to deal with the possibility of what goes on when there is another competing venue. There are some legal issues, and I will just point you to another interesting paper by Eric and friends. which is implementation details. In particular, there's the order protection rule. What happens if you have this auction and you march up the limit order book and that violates an order over at another market? And so they have an idea that, well, we could actually, the exchange that they have in mind could send what are called market sweep orders to take out the top of the book at other exchanges, and then they can trade at whatever price they want. And that probably could be done. I will just note that that takes time, that there is latency between whatever their exchange is and the, at now, 11 other exchanges that we have. It also raises the possibility of there being transactions sort of generated by trading interest at the auction exchange happening elsewhere before it happens on the auction exchange. And I actually haven't worked out the details as to whether or not that's an issue. Okay, this is all agglomeration issue. It wins if it wins, it loses if it loses. If everyone wants to go there, then everyone wants to go there. And if no one wants to go there, no one wants to go there. I don't have any deep thoughts on that. No deep thoughts on much of anything, I guess, here. But you know, what happens if we have a centralized limit order book, continuous market going on at the same time as BCS, British, Crampton, and Shim? Who would trade where? And this is me trying to think about the plausibility of this auction setting. And it seemed to me, if you're slow, you certainly don't want to be on the centralized limit order book. Why? Because if there is any success to this periodic auction, that is, if there's a reasonable amount of order flow there, it is going to be informative, which raises the possibility that high-frequency traders take the information from the single price auction and use that to pick off slow orders over on other exchanges. So that, at least from the beginning, looks like there might be some attractiveness to the single price auction. So that's some thinking of when we have one consolidated limit order book in the auctions. What do we have? We have 11 exchanges, we have 45 alternative trading systems, trading equities, and we throw in BCS on top of that. What does that equilibrium look like? Maybe that equilibrium, maybe this is such a great idea, and would not rule it out, that just drives everything else out, except the one or two exchanges that the buy side will insist will be there. So I think that's where we really need some more work, and if you guys are going to sell this, that's what's needed. But if you need a salesman, I'm happy to jump on board. Okay, it's a really neat data analysis, and there's some nice algorithms there for taking a mass of data, figuring out what the order book looks like to do this analysis. So I really recommend it. So the next thing I think we need to think about is the strategic interactions between what I'll call BCS and other exchanges. I note there's one paper out there. I did not find it that satisfactory because it sort of says, well, what happens if everyone trades at the same time every place? And that seems to me to miss sort of the main points. And with that, I'll close.